Everybody was buying today.
Well,
I mean, NASDAQ led the way, right? Nice pop for Apple, which haven't been able to say that much lately.
Yeah.
What do you think?
Well, I think tomorrow at the same time as we're sitting here today, you're going to be saying that this is the worst year for stocks since 2008. I don't think we're going to be able to erase that. I think we're going into January staring at mega caps, saying to ourselves, is a bottom in place? Is there further downside ahead? And quite candidly, the answer to that resides itself in earnings that we're going to be hearing about in the next 3 weeks.
I mean, earnings for big tech have not been bad. When they've been when they've been questionable, it's been supply issues, not demand issues. Enterprise spend has held up largely to this point. I wouldn't expect a fall out of bed kind of reporting from almost any of these.
So where's the pressure then? The pressure is exactly to your point, because the technicals are lousy for all of the mega caps. Boy, those fundamentals need to remain in place. You need the resiliency of earnings to make the argument that this is a moment to step in and either add to mega cap positioning or to introduce it to a portfolio.
Well, I mean, let's say like Apple, okay, for example. Yes, had a nice pop today. It's still below 130, right? Would you buy that stock today as much as it's come down? The worst since 08 performance this year. I mean, at some point, people are going to step into what has been the most popular and most loved stock in the market and say, you know what, enough's enough. And even if I don't get it all the way down to what it might settle out, who is going to do that anyway? So if I'm a long-term investor, why not now?
Spot on. So if you don't own Apple, yes, you could buy Apple stock right here. Will you incur further downside pressure? I'm sure you will. If you do own Apple stock, raise your hand. Most of America does.
That's why I bring it up.
If you do own Apple stock, the question comes, what did you do in 2022? Did you give yourself a degree of position flexibility? I traded Apple horribly, personally, through this year. I did make a decent move, though, at the end of October, and really that move was dictated from what I saw in my quality momentum strategy. The quality momentum strategy recognized that you began to see the momentum wane. So Apple was my largest position going into the end of October. Price then was about 153. I took that position. I made it equal weight with everything in the portfolio. That was a good move for me. Gave me a little bit of flexibility. I can increase the position sizing to Apple if we get on the other side of earnings, and I like what I hear.
Maybe you should do the Kramer method of Apple, right? You know what he says. I know you know the saying. He says it every time, right? What does he say?
Well,
he says, don't trade Apple, own it. Right, because it's too hard to mess around with the ins and the outs for what is still a company with tremendous earnings power. The fundamentals are great. The execution is great, right? I mean, okay, so it's a product of China. Supply chain issues have happened. Multiple re-ratings for all of the mega cap techs, but you can't point to much on the demand side, the fundamental side, and say, you know what, this company's better days are behind it.
For a passive investor, yeah, Jim's got the right approach, and I point towards the balance sheet as the evidence for why I think Jim's right. Fundamentally, this is a company that's going to return capital to its shareholders.
Right, they do a huge buyback.
It's going to make sure that margins are strong. So that, from that perspective, Jim's correct. There are others in the market that may choose to be a little bit more nimble. And for people like that, I always say portfolios are like fingerprints. They're all unique to the individual. So for a strategy that might work for Jim, that doesn't necessarily work for myself or for others. And the strategy that works for me is not going to work for myself or for others. But for someone who's really just sitting there, Scott, and truly is a passive investor and just going quarter to quarter and opening the statement and saying, oh, that's what the market did, Apple is not the type of stock that's going to hurt you very much.
But is it going to help you along with the other mega caps in 2023? I mean, to give you an idea,
the level
right?
of confidence for that, without question, has declined in the last year.
It has, because as we said, $10 trillion worth of losses have come out of U.S. stocks this year. Half of that's within like 7 of the mega caps. It's the tried and true ones that we talk about all the time. And, if you added NVIDIA and Tesla to that list, you have about half that number related to those losses. So we've been so reliant on them, both on the way up, and then we've been punished by them on the way down.
Well, there's a lot there in that analysis. First of all, let's understand the reasoning behind the outperformance over the last several years was the abundant liquidity from the Federal Reserve. That's gone, not coming back. In fact, I think the Federal Reserve is going to drain even more liquidity in 2023 out of the market than they did in 2022. What does that mean for you as an investor? You really can't passively invest anymore because you're not going to have the top of your batting order that's going to be hitting 350 with 30 home runs and really scoring all the runs for you.
Well, says an active, ETF manager.
Who's equally weighted.
Yeah.
Now, equally weighted strategies have come back into favor in 2022, and I would say, given the evidence, until we're able to get clarity on monetary policy, the economy, and earnings, I think that's the right approach. Why? What does it incorporate? Diversification. And diversification ultimately is, for every investor, the best financial tool you could be utilizing.